Welcome to another deep dive. Today, we're taking a really fascinating look into a company that's been, well, quietly navigating some pretty big shifts in the industrial and construction supply world.
Mhm.
We are talking about Fastenal.
Right.
We've got their latest Q2 2025 earnings report, the earnings call transcript, a good stack of insights here.
Yeah, plenty to dig into.
And our mission today really is to unpack how this company managed to hit record revenue numbers in what they themselves are calling a, quote, sluggish market.
That's the key paradox, isn't it? Sluggish market, record revenue.
Exactly. We'll look at the numbers, sure, but more importantly, the strategy, the how, and the why behind this performance. Get ready for some interesting details.
Sounds good.
So let's just jump right in. Fastenal hit a huge milestone. First quarter ever, over $2 billion in net sales.
$2 billion. Wow.
Yeah, $2,080.3 million, to be precise, in Q2 2025.
Okay.
And this wasn't just a small step up. Net sales were up 8.6% compared to Q2 last year.
8.6%. That's pretty strong growth.
It really is. And if you look at daily sales, same story, up 8.6%, hitting $32.5 million per day this quarter, up from about $29.9 million.
So consistent growth across the board there.
Right. And it flowed down to the bottom line, too. Net income jumped 12.8% to $330.3 million.
Okay.
And diluted net income per share grew 12.7% to $0.29.
So strong top line, strong bottom line growth. But like you said, they're calling the market sluggish.
Exactly.
And this 8.6% daily growth is actually their highest since, what, early 2023?
That's what they said, yeah.
So it immediately makes you ask, right, if the market isn't lifting them, what is? What's driving this?
That's exactly it. This really seems to be about internal strategy, internal execution, not just riding a market wave. And one of the core drivers they highlighted was this momentum in customer contract signings. It's been building over the last 6 quarters.
Oh, contracts.
Yeah, contract growth went from like 4% back in 2022, 2023, jumped to 11.2% last year.
That's a big acceleration.
Huge. And it kept going in Q2. They signed 84 new contracts, which they said was well ahead of what they expected.
This is critical, right? Because if you connect that to the bigger picture, contract customers now make up, what, 73.2% of their total revenue?
That's the number, up from 71.2% a year ago.
So this isn't just, random sales. It shows a really deliberate strategy. They're moving beyond just being a distributor.
Right. More of a partner.
Exactly. An embedded supply chain partner. Locking in these contracts builds incredible stickiness, resilience, makes them way less vulnerable to, market ups and downs.
That makes sense. And it's not just more contracts, it's also how those contracted sites are performing. They saw unit sales increase, mostly because they have more customer sites spending over $10,000 a month. And also the average spend per site went up too, across the board.
So bigger accounts getting bigger and more bigger accounts overall.
Precisely. Those sites doing $10 sale plus a month, revenue up 11.6%. And the number of those sites grew by almost 7%.
Okay, solid growth there.
And then their biggest accounts, the ones over $50K a month, they call them on-site-like customers.
Right.
Their site count grew 12.4%, and the revenue from them was up 14.5%.
Wow. So the big customers are really driving a lot of this.
Seems like it. Overall, monthly sales per customer site jumped 17.7% to nearly $6,800.
Which does lead to an interesting point they made about smaller accounts, though. The under 500K a month ones.
Right, they saw a decline there.
Yeah, and they said most of that was really small customers, like under $500 a month, especially under $100.
Which they kind of expected, didn't they, given the focus on larger sites?
They did. It was sort of an anticipated consequence of that strategic focus. But they're not just, ditching them entirely.
No, they mentioned the Fastenal.com relaunch.
Exactly. Coming later this year, aimed at those bought-by needs. So trying to still serve that transactional, smaller customer base, just maybe more efficiently online.
Gotcha. Okay, so beyond customer growth, pricing also played a role.
A positive one this time.
Yeah, added about 140 to 170 basis points to net sales in Q2.
So roughly 1.4 to 1.7% uplift just from price.
Which contrasts with Q2 last year when pricing was actually a drag.
Right, that's a significant swing.
And foreign exchange. A small positive bump, too, about 10 basis points.
Okay, so mostly internal drivers, but pricing helps too.
Definitely. Now, if we dig into their operations, product lines, and markets, there's kind of an interesting split.
Okay.
Fasteners, nuts, bolts, screws, both for OEM manufacturing and MRO maintenance, they still lagged the non-fastener stuff.
Which makes sense if industrial production is sluggish, like they said.
Exactly. But They did show better growth this quarter compared to last year.
An improvement, okay. Why was that?
Combination of things. Easier comparisons to last year, those big customer signings we talked about, better product availability apparently, and those pricing actions.
Got it. So still lagging, but improving. What about non-fasteners?
Safety supplies were strong, up 10.7% daily sales rate.
Okay. Why the strength there?
Seems like less volatility from, the crazy PPE demand swings of the pandemic. More steady MRO use now. Plus, their vending machine base grew, and they had success with warehousing and data center customers.
Data centers. That's a growing area.
Definitely. And other product lines showed a similar trend, higher growth in MRO stuff like electrical, janitorial, less growth in OEM-focused lines like cutting tools, welding.
So again, reflecting that softness in general manufacturing, but strength in maintenance and newer sectors.
You got it.
It really paints a picture of them adapting, right?
Yeah.
If OEM is soft, they lean into MRO, they find growth in warehousing, data centers.
Yeah, it shows agility.
A really adaptive sales force and an inventory strategy that can pivot.
And speaking of strategy, this brings us to the tech side. FMI, their managed inventory and e-business. This is where it gets really interesting for, the modern economy.
Absolutely. FMI is huge for them.
Right. It includes fast stock scan locations, fast bin using infrared, RFID scales, and fast vend the vending machines.
All about automating that inventory on the customer site.
Exactly. They signed up almost 6,500 weighted devices in Q2. Year to date, that's nearly 13,000.
Okay. How does that track against their goals?
They did adjust their full year goal for signings down slightly to 25,000, 26,000 MEUs, their measurement unit.
Okay. A slight adjustment.
But still, the total number of installed devices hit over 132,000 at the end of the quarter. That's up almost 11% year over year.
That installed base is still growing nicely. And what's really key is how much revenue flows through it.
Right. Sales through FMI reached 44.1% of total sales in Q2.
44%, up from about 41.8% a year ago.
Yeah. And they think that number could eventually get to around 65% for the right kind of customer.
That's incredible penetration.
Yeah.
It just embeds them so deeply into the customer's workflow. It's not just selling parts anymore.
Absolutely. Makes them indispensable. And that digital push goes beyond FMI, too, with their broader e-business.
Right, the online side.
E-business sales grew 13.5% in Q2. And for the first time ever, it broke 30% of total sales. Right on the dot, 30.0%.
30% through e-business. That's a major milestone.
Huge. So if you combine FMI and the other e-business sales, what they call their digital footprint, that now accounts for 61% of total sales, up from 59.4% last year.
61%?
And their goal is to end 2025 somewhere between 63-64%.
Very strong digital adoption. But you mentioned the FMI signings goal was adjusted down slightly.
Yeah, just a bit.
Did they say why? It seems like such a core part of the strategy.
They did address it on the call. They kind of attributed it to the finite energy in the room, as they put it, meaning a lot of the conversation time with customers recently has been taken up by discussions around tariffs.
The tariff issue, sucking up the oxygen.
Pretty much. So less bandwidth, less focus maybe on pushing for new FMI installations during those talks.
That makes sense. It's a good reminder, isn't it, how these big external factors like trade policy can ripple down and actually affect internal priorities, even something as strategic as FMI deployment.
Definitely. Okay, shifting gears a bit. Profitability. Beyond the great top line, how did they manage margins?
All right, the gross profit.
It actually ticked up slightly, 45.3% in Q2 versus 45.1% last year.
Okay, a slight improvement. What drove that?
Couple of things. A slightly favorable price-cost situation and better margins on fasteners, which they linked to this fastener expansion project, and some supplier initiatives.
Okay, so some internal efforts helping there, but were there headwinds?
Oh, yeah. Several things pulling the other way. Customer and product mix was one.
How so?
Well, stronger growth from big customers and non-fasteners. Those usually have slightly lower gross profit percentages.
Right, the mix effect dilutes the average.
Exactly. Plus, higher import duty costs related to tariffs again, and higher fleet and transportation costs from inflation.
Makes sense. Fuel, logistics, all that's up.
And they mentioned customer and supplier incentives were also a small drag. So kind of a mixed bag on gross margin.
And what's their outlook there?
They expect the full year 2025 gross margin to be relatively flat compared to 2024.
Okay, so holding steady despite the pressures. What about operating expenses? SG&A.
They actually managed that really well. As a percentage of sales, SG&A decreased, down to 24.4% from 24.9% last year.
Nice leverage there. How?
Basically, sales grew faster, 8.6% than SG&A did, 6.3%.
Good cost control or just benefiting from the higher sales base?
Bit of both, probably. Employee costs, which are the biggest chunk of SG&A, like 75%, they did increase 10.3%, mostly from hiring more people and slightly higher wages.
Okay, so investing in people.
Yeah. And interestingly, bonuses, commissions, profit sharing, those actually went up faster than sales did.
Faster than sales. What's the story there? Usually you want those aligned or growing slower.
Well, management actually framed it as a positive thing. They called those compensation elements shock absorbers.
Shock absorbers.
Yeah. They pointed out that employees took, in their words, pretty extreme pay cuts back in 2023 and 2024 when things were tougher.
Ah, okay. So this is payback time, essentially.
Kind of. Rewarding the team for the strong performance now, celebrating that shared success after tightening belts earlier.
That makes sense. Good for morale, I imagine.
For sure. And ultimately, all this led to higher operating income as a percentage of sales, too, up to 21.0% from 20.2% last year.
Solid improvement in operating margin, then. Okay, let's look at the balance sheet. Cash flow, debt, investments.
Right. Cash flow from operations was healthy. $278.6 million in Q2, up 8.1% year over year.
Good cash generation.
Accounts receivable money owed by customers up 9.9%.
Which tracks with sales growth, especially with bigger customers maybe having longer payment terms.
Exactly what they said. The interesting one is inventories. Big jump there, up 14.7%.
14.7% on inventory. That's quite a build. Why so much?
They gave three main reasons. One, just supporting the projected growth they see coming.
Okay, stocking up for demand.
Two, anticipating potential tariffs, hedging their bets there.
The tariff impact again? Pre-buying, maybe?
Could be some of that. And three, specific initiatives like their fastener expansion and optimizing package quantities.
So strategic inventory building, not just getting stuck with stock?
Seems that way. And they actually said this investment has already been paying off in the first half of the year.
How so?
By freeing up time for their field teams. Less time chasing down parts, more time focusing on customers.
That makes sense. An investment in efficiency, really.
Yeah. And on the spending side, capital expenditures were up too. $64.3 million in Q2 compared to $52.6 million last year.
Investing in what?
More FMI hardware, expanding those distribution hubs in Utah and Atlanta, and IT projects. Their full-year forecast for CapEx is $250 to $270 million.
So continued investment in growth infrastructure and technology.
Absolutely. And importantly, their balance sheet remains really strong. Total debt is super low, just 5.7% of total capital.
Very conservative leverage. Healthy.
Very. And they returned cash to shareholders $252.5 million in dividends this quarter. No stock buybacks, though.
Okay. Dividends prioritized this time.
Yep. Now, we've touched on it a few times, but let's dive into those external headwinds directly, especially tariffs.
Yeah, the elephant in the room.
For sure. Their regional leaders are still reporting sluggish demand out there, and trade policy is definitely creating caution.
But they didn't see much pre-buying ahead of tariffs.
Not really, no. Not meaningful amounts.
Okay. So how are they responding? You mentioned pricing actions.
Right. They've been really proactive, diversifying the supply chain, talking constantly with customers.
Trying to get ahead of it?
Yeah. And they did 3 separate pricing actions just in Q2, aiming for those to add 3-4% to pricing by the end of the quarter.
3 actions in 1 quarter. That's aggressive.
And they expect more in the second half of the year.
Wow. So passing those costs through.
Well, yes, but the way they talk about it is interesting. It's not just about raising prices.
What's the nuance there?
Their stated goal is to be the best supply chain organization and give customers visibility to manage their own supply chains.
Okay, positioning it as a partnership benefit.
Kind of. Like, they mentioned redirecting product directly into Canada or Mexico, if the economics make sense, even if it makes their supply chain a bit more complex or expensive initially. It's about ensuring that consistency and availability for the customer.
That's a sophisticated approach. More than just hiking prices across the board. How are customers reacting to all this tariff talk?
It's evolved, apparently.
Yeah.
Initially, the conversations were all about just make sure we get the product. Don't shut us down.
Right. Security of supply was paramount.
Now, it's shifted much more towards price. Okay, what's this going to cost me?
Understandable. Tariff fatigue setting in.
Definitely. They mentioned fatigue among customers, their own employees, even suppliers. Everyone's just trying to navigate this constant uncertainty.
Exhausting.
Yeah. But Fastenal sees their global footprint and consistent service model as a real advantage here. When customers crave stability, they feel they're well-positioned.
That makes sense. A competitive edge in uncertain times.
So, as we kind of wrap this up,
Mhm.
what's the big takeaway for you from this quarter?
It's really a story of execution, isn't it? In a market they admit is sluggish, they're not just surviving, they're actively thriving.
Yes, striving is the right word.
It's driven by that clear internal strategy, the focus on contracts, on larger customers, the massive investment in FMI and digital.
Right, the digital footprint reaching 61%.
Exactly. And their ability to manage the supply chain complexities, navigate tariffs, even if it means adjusting pricing significantly. It's about controlling what they can control.
Mm-hmm. Leveraging those deep customer relationships, optimizing the nuts and bolts of the operation.
Yeah, it's a testament to internal alignment and just a relentless focus on customer value, even when the market isn't doing them any favors. They're proving you can drive market share gains through strategy and execution, regardless of the broader environment.
It really is impressive. Which leads to maybe a final thought. In this world we're in, with seemingly constant supply chain disruption, shifting trade policies, changing customer needs, how might Fastenal's approach this deep embedding with customers via technology, this focus on being a supply chain partner, not just a seller, how might that actually reshape the whole industrial distribution landscape going forward?
That's a great question. Are they just succeeding within the current model, or are they actively creating a new model for the future?
Something for all of us to think about until our next deep dive.